Hi everyone, how are you doing today? Hope you have had a great day so far. Today I'm going to do a valuation of Lloyds Banking Group because, well, I just love doing valuations, that's why. So we love investing on this channel, and valuation is the best way to do some investing because you're getting the actual value of the company, and you'll be able to see how I go through things and how I value a company, and then you can go and do it for yourself on any company. So let's get started straight away. I'm looking at Lloyds Banking Group today now. I've built up a sort of portfolio of all the banks that I've been watching for quite a long time now, years and years and years. And these are kind of like the major banking groups on the London Stock Exchange, the UK market. Lloyds Banking Group is one of the biggest banks on there, along with HSBC is the largest by far, and Lloyds Bank is behind that. So what we're going to do is we're going to look at the market cap, we're going to look at the revenue, we're going to look at the profit, and we're going to show the unorthodox investor return, the UIR. And what that means is that just breaks down what return you are likely to see from an investment, much like a kind of interest rate that you would get on a bank account. That's the way the unorthodox investor return works, and that's kind of what I use for myself to calculate my sort of return projected into the future from a stock. So let's have a look at Lloyds Banking Group. What's it done over the past year to date? So year to date, we are down about 11%, which is not great. So what is going on? What is driving that decrease? Well, Lloyds Banking Group have the largest amount of UK mortgages, and in periods of high inflation like we've got just now, those mortgages have been fixed at some point in the past, and so as inflation increases prices, Lloyds are not able to increase those mortgages at the same rate. They have to wait until the year is up, or the 2 years, or the 5 years is up before they can then raise those interest rates. So investors are not liking that Lloyds has that lag, and that's why the share price is possibly going down a bit. It could just be randomness as well. I've read a really, really good book recently called Fooled by Randomness, and it's about financial markets, and it says how we can see what the news says, and we kind of assume that because the news says that, the share price is doing that, but actually a lot of it is just randomness. So it could just be randomness as well, but that's my take on why the share price isn't doing as well this year as maybe some other stocks. If we kind of have a look over the kind of 5-year period, we can see that obviously Lloyds fell during the COVID year of 2020, just like a lot of the other stocks that you will see. In fact, most of them. And it's recovered somewhat, but still only to about half of the level that it was at previously, kind of between 60 and 70p before then, and now we're about 44.5p. So Lloyds Banking Group have recently started doing a share buyback to try and boost the share price, but it's not really had any sort of effect at the moment. I can't quite remember off the top of my head how much that was, but we can check that very soon. We can check that on this video. But let's just do a quick evaluation of Lloyds as it stands currently, so we can see where we're at and whether Lloyds is potentially at a good value at today's price. So here's my stock valuation, very, very simple, very basic methodology. And what we're going to do is we're going to take the profit and the market cap, and essentially it's like working out the PE of the stock. What I do is I turn that into percentage. And for me, it allows me to see the percentage return I will get every single year if the company continues to perform exactly the same way. And it makes it just very, very simple for me to just see, what stocks are more valuable than others. So that's the way I like to look at it. So firstly, let's jump into Hargreaves Lansdown, one of my favourite websites, and let's look up Lloyds Banking Group now. I'd already looked this up before, so that's handy. It's just there for us. And then we're going to first put in the market capitalisation. So that's 30.5 billion. So that's we're going to put the market cap in million. So that's 30,500. So that's 30.5 billion there. Then we're going to look on to the financials and grab the profit figure. I'm going to do that for the last financial year. So in at the end of 2021, we had a profit of almost 6 billion. So it was 585 million essentially. So let's pop that figure in here. And we can see we get an unorthodox investor return of 19.3%. So what that return basically tells us is that, and this is profit after tax, is that the company should be returning around about 19.3% per year, which is really, really, really good. You won't find many companies with that high return. So already things are looking pretty good. Normally I take the revenue of a stock as well, so I'm going to pop that in. And we can see that for the banking stocks, Lloyds, 2017 was up at 34, 2018 down at 22, 2019 up at 42. So you can see like this very kind of up and down, and that's kind of what happens with banking stocks. I'm yet to kind of like, in all honesty, I'm yet to kind of figure out what these kind of ups and downs are because of. But a lot of these banks are sort of investing and trading as well, and what that means is they do have bad years and they do have good years. So the revenue I'm just going to put in for last year, which is 37.444 billion. So we'll just put 37.4 billion there. And then have a look at the debt as well. That's always an important figure just to look at, because if a company has zero debt, then it's pretty safe. So actually, Peter Lynch is one of his famous quotes is that if a company has no debt, it's virtually impossible for it to go bankrupt. You'd take a lot of skill for a company to go bankrupt with zero debt. So it's always nice to check the debt figure and kind of see where a company lies. So you can see that Lloyd's debt figure, as per Hargreaves Lansdown, is 13.1 billion. So we'll put that in there, and we can always have a look at that later on. In future videos, I'm going to have a look at all the banking stocks, but today we're just going to do Lloyd's and have a little look. So already the unorthodox investor return sitting at 19.3% is pretty handy. So you should be kind of expecting a 19.3% increase on your investment every single year as long as the company continues to perform. So is Lloyds performing? Because these figures were from the end of 2021. So Lloyds has released its half-yearly report already this year, I think back in June. So let's go on to another one of my favourite websites, London South East. LLOY is the code for Lloyds. So I'm just going to type that in, and we can have a look at the latest news. So this tab here, if you want to call it a tab, it's more like a picture. Live RNS. I quite like this because it just gives the company announcements. You've got Lloyds Share News here as well. If you click on the news, that's news articles. So that's people essentially writing their opinions, from different news articles. I'm not really interested in that. That's a lot of noise. You don't really need to involve yourself in that. But I want to see what the company is saying, what Lloyds themselves are saying about their own business, and that's all that's important, really. So if we scroll down, we'll see, of course, lots of transactions and own shares, and that is the share buyback. So every single day, Lloyds is buying back a bunch of its own shares. And if we click on one of these, you will see that, so date of purchase, 22nd of August, Lloyds purchased 44 million shares on the 22nd of August. So what we can do is we can say that 44 million times, and the share price is 44 pence, 0.44. So that's 19 million pounds worth of shares per day Lloyds is buying, or at least today today is the 22nd, depends when you're watching this video, but the day that I'm recording this video, Lloyds bought back 19 million pounds worth of shares. So quite a lot of shares they're buying, but the share price is obviously still going down. So it's not enough. You need to buy more. So let's go back to the news, and I wanted to go down to the half-year report, which was quite recent. So here we go. We've got the half-yearly results on the 27th of July, so that was only 4 weeks ago. Depending on when you're watching this video, it could be a couple of months ago, but still relevant until potentially this time next year. So what we're going to look at, we want to look at the profit figure. So that's what I wanted to see, because we were looking at the profit figure from 2021, the end of 2021. But now we want to look at the half year and see where Lloyds is sitting. And here, profit after tax for the half year 2022 was 2,441 million, which is approximately 5 billion for the full year if Lloyds continues to perform this way. So let's update this figure to 5 billion because it's obviously gone down just slightly, but if we update this figure to 5 billion profit after tax for the full year this year is what we're hoping to get. It's not, of course, guaranteed, but that's still an unorthodox investor return of 16.4%. So I'm looking at this and I'm thinking I can't really put my money anywhere in any bank that's going to get me 16.4% interest. So therefore, personally, I'm looking at this with quite a lot of interest. So with quite a lot of, I quite like this investment at this level at the moment. But obviously, it doesn't mean it's for everybody. And of course, we're just looking at very basic figures here. The stock price is going to go up, going to go down, going to go up, going to go down. So depending on where you purchase it as well, that depends on whether you're going to get that 16.4% and how long it's going to take. With every investment that you make, you should be looking at between 5 and 10 years, maybe longer, 20, like 15, 20 years, 30 years. You know, the best holding period is forever, and everybody should know that by now. And if you hold a 16.4% returning investment for a long time, you're going to do quite well. So why is Lloyds kind of returning that? Well, actually, before I go into that, let's just have a look at the cash flow statement. That's always another thing I like to have a look at. So if you just type Control F, you can search in the document. So cash flow statement. Let's go to the cash flow statement here. So and I like to just have a little look just at the very bottom figure in the cash flow statement, and you'll see change in cash and cash equivalents. You see cash and cash equivalents at beginning of period and cash and cash equivalents at the end of the period. Now, ideally what you want to do is you want to see that profit falling through into the cash. And so we had a profit of, it was 2.5 billion for the half year. And you can see the change in cash and cash equivalents is actually 14 billion. And if we scroll up, you can kind of see what the major figures are. And you can see net cash provided by operating activities is almost 14.5 billion. So you can see that on some level, in fact quite a big level, that profit is flowing through to cash. And you can see here that the cash and cash equivalents have increased to 70 billion. Which it seems absolutely incredible. An incredible number when Lloyds' market cap is only at 30 billion. So it's a massive float you have there. So you're purchasing almost more than £2 for your £1 investment there of cash, which obviously seems quite nice. But banks have to hold a large amount of cash for things like defaults and really that is the worry, and that's why the stock is valued quite low right now. Investors are not kind of buying the stock, otherwise the unorthodox investor return would be a lot lower. So people are sort of worrying that the sort of recession and inflation are going to cause people to default on their mortgages, of which Lloyds is the biggest owner of mortgages in the UK. So that, for me, seems like the biggest reason that Lloyds is kind of a little bit undervalued there. Or I say undervalued, it depends on kind of how you value it, of course. So there you go, there's a little valuation of Lloyds there. Of course, you can do this for absolutely any company, and it's a very, very basic calculation. But you'll see me do this calculation a lot on this channel because this is what I love doing. I just love valuing businesses. This is the way I do it. And there's a couple of other things you need to take into account, things like growth. You, of course, need to take into account the economy and the current situation of the company. But if you're just looking at sort of profit versus the market cap, it gives you a really good idea if the company is worth buying or not. And it gives you kind of like a little bit of a risk profile, and it really tells you about the margin of safety that Benjamin Graham always talked about, and it's the thing that Warren Buffett, Manish Pabrai and Charlie Munger, they all of these investors, they require really good companies with a really good return and a very good margin of safety, and when you see a really solid company making good profits, then it's you if you get enough of those companies, you're gonna do pretty well. So there you go, guys. That was a little valuation on Lloyds there. I hope you enjoyed that. Feel free, definitely hit the subscribe button and follow along, because I'm going to be doing more of these videos. I'm going to try and do these videos for every single one of the members of the FTSE 100, and we'll get a little table going here as well. And also I'm going to do a comparison with Lloyds with the rest of the banking stocks, because that'd be very useful to see, if you're going to invest in banking stocks, which ones are the ones to go for or which ones are the ones to maybe avoid. So hopefully you have a great week, guys, and nice to see you, and I will catch you on the next video. Have a good one.